talked about the returns that the mid-cap category of mutual funds gave around 21% compounded returns in the last 10 years.
Hello everyone and welcome to our channel, The Mutual Fund Guys, where we talk everything about mutual funds. My name is Samir Gilani and on the other side is Mahesh Bhagwat, and we are partners at AMS Investments. AMS Investments is a mutual fund distributor based out of Mumbai with an office in Dubai. We manage portfolios for about 100 plus clients. Having said that, let's dive into today's topic. We're going to be talking about equity mutual funds and the different categories of equity mutual funds. As many of you might be aware, there are different categories of mutual funds in our country. There are equity mutual funds, there are debt mutual funds, and there are also hybrid mutual funds. And today we'll be talking about equity mutual funds and the different categories in it. Before we begin the classification of equity mutual funds, we need to define a concept of market capitalization, or also known as market cap. Now, simply put, market cap is essentially the number of shares that are available in a country multiplied by stock price of that company on that particular day. For example, Voltas, a company that we are all quite familiar with, it has around 33 crore shares outstanding, which are available to everybody. And the price per share of Voltas is currently around 1,000 rupees right now. So if you take the total number of shares, which is 33 crores, and multiply it with 1,000 rupees per share, we get a total value of a company at 33,000 crores, right? So this is the total market capitalization of Voltas. It essentially tells you the value of a company at any particular point in time. Now, it's based on this principle of market capitalization that there are three categories. Okay, so the category number one is called large cap, category number two is called mid cap, and category three is called small cap. These are the three different categories. SEBI, which is the Security Exchange Board of India, the regulator of all financial markets in our country, has essentially defined what a large cap company is, what a mid cap company is, and a small cap company is. So as per SEBI's definition, the top 100 companies in terms of market capitalization, they are defined as large cap companies. If you think of companies such as HDFC, TCS, Hero MotoCorp, these are the companies that we are all familiar with. They would be in the category of the large cap companies. They are the top 100 companies in our country.
The Reliances of the world, the well-known companies.
Well-known companies, yeah. The next category, so the next 150 companies under the top 100 companies, I'll call them mid-cap companies. They are smaller than the large cap companies, but they're not also very small. Okay, so that's the next category. Any stock or any company that doesn't fit into the category of a large cap or a mid cap is then termed as a small cap company. So it's fairly simple. If you look at the definition, the large caps are the top 100, the mid caps are the next 150 companies, and everything else is the small cap company. This definition of large cap company, mid cap company, and small cap company, that there have been different categories of mutual funds. Okay, so Mahesh, maybe we can jump right into that and explain the different categories of equity mutual funds.
So what SEBI did, as you rightly said, is that define what is large cap, what is mid cap, and what is small cap, right? And using these definitions, it has then decided what would be the different categories of mutual funds. So the first category that comes to mind is the large cap category of mutual funds. In that, the fund manager has to invest 80% in large cap stocks, which means that he has to invest 80% of his money in the top 100 stocks of the company. As you said, the well-known names, Reliance, HDFC Bank, SBI, maybe TCS, Infosys. So, when you buy a large cap category of mutual fund, you're actually saying that 80% of my money will go into these kind of stocks, the top 100
companies. The top 100 companies are right.
The remaining 20% can be in anything. The fund manager could be investing in mid-cap stocks, could be investing in small-cap stocks, or could be keeping in cash. That is to his discretion, right? So SEBI is very clear. It's simple definition. You first categorize the companies by market cap and then define what are the different categories.
On an average, Mahesh, this large cap category of funds, what sort of returns have they delivered for investors in the last 5 or 10 years?
period of 10 years, these large cap category of funds on an average. So when I include all the all the schemes in that category, and then when we look at the average returns that they're given, that's 15%. And that's not small, 15% compounded for the last 10 years. That's a huge return.
So 15% every year for the last 10 years is what the...
Not on clockwork, but on an annualized
on an average basis.
Yeah. So that's what they have done. The next category, which is the mid-cap category of funds. In the mid-cap category of funds, we have, SEBI has said a very simple thing, that the fund manager has to invest minimum 65% in the mid-cap category of stocks. Mid-cap category of stocks, 65% of the money goes into that. The remaining 35% could be in anything, large caps, small caps, or cash. Right, so that's what is the definition for mid-cap category of mutual fund.
So an investor who's investing in a mid-cap category fund, he or she has to keep in mind that 65% of that money will be compulsorily invested in the 150 companies below the 100 companies as defined by SEBI in terms of the total, in terms of market capitalization. Okay.
That is true.
Okay.
That is true. Like we talked about the returns that the mid-cap category of mutual funds gave around 21% compounded returns in the last 10 years. That's the kind of money that mid-cap category of mutual funds have given to investors in the last 10 years.
21% every year for 10 years on average is actually phenomenal.
It's phenomenal, But then if that is phenomenal, then we have another category called the small cap category of mutual funds, right? As per SEBI, that category, the fund manager has to invest 65% in small cap category of stocks. And again, 35% can be across the spectrum or in cash, right? So that's how SEBI has defined it. In the last 10 years, that category of mutual funds has given 23% compounded returns to investors. So, we have large caps at 15%, mid caps at 21%, and then small cap category of mutual funds at 23%. That's the kind of return that mutual funds have done in the last 10 years.
The large cap, mid cap, and small cap are fairly simple and straightforward to understand. There are more categories available for investors, and the more popular categories are the flexi cap fund and the multi cap fund.
So SEBI definition for, let's say, large and mid cap, right? In that category of funds, the fund manager has to invest 35% in large cap and 35% in mid cap. The remaining 30% is at his discretion. So very simple, because he can invest 35% in large cap and 35% mid cap, that category is called large and mid cap category, right?
And that category over the last 10 years, the returns would be how much?
Yeah, that category, surprisingly has given 18% compounded returns, which, actually coincidentally happens to be the mid of the large cap returns and the mid-cap category returns. So 18% is like in between, right? So this category, large and mid-cap, has given 18% compounded returns. Then if you think about it, as you mentioned, there are two other categories in the diversified category.
The more popular ones,
The more popular ones are the flexi cap and the multi-cap. And we'll talk about flexi cap. There, SEBI has put no constraints other than one, which is that the fund manager has to invest 65% in equity across the spectrum.
He could invest in small caps also, mid caps, large caps. He or she, the fund manager, could invest anything.
There's very little constraint in the flexi cap category, except that you have to remain invested 65% of your money. Then they have also created one more popular category, I think a category which is getting popular now, which is called multi-cap. And in multi-cap, the fund manager has to invest 25% in large cap category of stocks, 25% in mid cap category of stocks, and 25% in small cap category of stocks. And that is why it is called multi-cap, right? It is across the market capitalization. So the remaining 25% could be in anything.
And how do you compare the return between a flexi cap fund, Mahesh, versus a multi-cap fund in the last maybe couple of years? Because I think multi-cap was more recent.
Multi-cap is a more recent invention. So, but still some of the funds have a 10-year track record. And on an average, multi-cap funds have given 19% compounded returns for the last 10 years, whereas the flexi-cap category of funds have given 17. So if you look at the diversified category, you see that flexi-cap has given 17, large and mid-cap has given 18, and multi-cap has given 19. So 17, 18, 19.
So basically, generally as a category of equity mutual funds, this 15 to the 16 to 18%, 19% returns are what is the general norm
Yes.
of the last 10 years.
We all know, I mean, both you and I know that anything like 15, 16, 17%
Yes.
is incredible, right? I mean, that really changes the wealth of an investor.
Yeah, I mean, I think people fail to realize what a 15%, 16% compounding every year does over the next 10 years. It's a phenomenal number because the power of compounding is, as we will discuss in other videos, how essential it is to build long-term wealth. I think, when we have the availability of such funds with so many different categories that we can pick from, and they all have given very they've given very decent returns. In these returns over 10 years, really amplify your wealth. And I think this is the key
change your wealth profile, right?
Profile. And I think it's a very easy option to access as an investor in India. You can access these funds quite easily. You can open an account with any platform and you can invest. I think this is one of the biggest advantages that we have in a country, to have access to such incredible mutual funds with such incredible companies and stuff. And I think people need to really focus on that. Now, there's one more category or a couple of more categories, Mahesh, which are of course there, but they are obviously a little bit different. The value equity category, there's a contra fund, and then there is also something called thematic and sectoral. Maybe we'll just briefly talk about these because they're not very popular, but they still exist out there.
They still exist, and people need to know that for the sake of completion, that there is something like this. So SEBI created a category called value category, where the fund manager has discretion to invest in equities across the spectrum, but the only condition is that he has to be invested in value stocks. So he has to be able to justify his purchase as to why this is value. And the typical way we all look at value is low price to equity or low price to book. But the fund manager could look at various other metrics for defining value, and the requirement that the fund manager has is that he has to invest in something which is value. So that's one fund. Then we have something called the thematic fund and the sectoral fund. And in the thematic fund, it is basically, say, manufacturing is a theme, right? Or infrastructure is a theme, or consumption in India is a theme. So, when you say thematic funds, these are typically the kind of funds that have been created by various mutual fund houses. So when you buy an infrastructure fund, then you know that you're buying into something which would be considered as in infrastructure stock, right? It could include even cement or banking, because banking is also infrastructure, but across the spectrum of infrastructure, this infrastructure fund will be investing into. Similarly, manufacturing can include pharma manufacturing, could include auto manufacturing or anything. But buy a manufacturing thematic fund called manufacturing, then you would be buying into these set of stocks, right? So there would be no services in them. There would be only manufacturing companies in them. Similarly, if you invest into consumption, then it would be consumption stocks. So consumption could include fast FMCG stocks, could include consumer durables, could include cement, anything. And then finally, there is there's something called the sectoral fund. And that fund is again something like a pharma sector fund or a banking sector fund or a technology.
Focus on a particular sector only.
Yeah, that's particular sector, and far more homogeneous. So, right, when you say pharma, it will only include pharma. It can't include other stocks in that. So,
okay, I mean, that's amazing. I think just to sum up, the popular categories of equity mutual funds are the flexi cap, the multi cap, and the large and mid cap categories. Of course, there are other categories that we've discussed. The purpose of this video was essentially to help our viewers to understand, what generally are these equity funds and how are they being defined by SEBI, and when they invest into these funds, they should know, what categories they've actually invested in. That's the whole purpose of this video. We will come up with series on a different category of mutual funds called debt mutual fund and hybrid mutual funds. That will be our next video, hopefully. If any of you watching this video have any questions, please write to us at hello@amsinvestments.net, as seen on your screen below. And we'll be happy to sort of help you out with your portfolio, and we'll be happy to even do a free consultation for you. Thank you for watching, and hope to see you guys soon. Thank you.